watchdog.com. Today we have a guest that people have been asking for since I've been doing videos. I can't tell you how many times, I don't know, 50, 70, 100 times people have either sent me an email or left a comment on the site that said, you really need to get Jim Sinclair on. And, you know, Jim Sinclair travels internationally. He's in and out of his office all the time. And finally, we've gotten Jim Sinclair of JS Mindset, Mr. Gold. Jim Sinclair, thank you for joining us today on USAWatchdog.com.
Well, thank you, Greg.
I'm just going to give you a little more introduction. You're a published author. You've written books. You have traded derivatives in a darker period in your career, as you said. You've owned brokerage houses. You are a big-time investor. You own a mine or mining concerns, the Tanzania Royalty Exploration Company. Is that right?
That's right.
Okay, and you know, so you are, they call you Mr. Gold. You are an expert on gold, and I just want to continue this introduction just a little bit longer. I've done some research on you, and you have made a couple of monster calls in gold. In '74, when gold had gotten up just, you know, about $160, $70 an ounce, it hadn't quite peaked in '74, peaked in terms of it in that time. You said that gold would go to around $900 an ounce by 1980, and sure enough, it did. Now, with that call, you had a terrible fall-off from around $200 down to $100 an ounce, and it took 3 years to get back to $200, but your call that it would be about $900 an ounce, I think it was $887.50 in the intraday high, big call. Call number two. Let's fast forward to 2000, about 2002, and gold was in that year, and I don't know exactly when you made this call, but you made the call in late 2002, and gold was trading for about $360 an ounce, and you said on or before January 14th, 2011, it'll be $16.50. Well, it took until June of 2011. I think it was $15.80. I mean, you know, you're hitting the red there. Maybe not exactly in the middle, but you're in the bullseye. And it did hit $16.50 just a few months later in the summer of 2011. Now, here we are again, and you are out here. And before we make any calls, I just want people to understand, and this is a long introduction, I'm sorry, but I'm so excited to have you. I just want people to understand the fundamentals of gold. I just want to go back to the fundamentals of gold. Why should people own gold, physical gold?
Well, the reason is simple. Gold is insurance. And what it insures you against is everything that has to do with the confidence in which gold, the currency, is traded, the dollar. So all of this debt situations, even NASA spying on our allies, anything that can affect confidence in the U.S. dollar is hedged by, insured by gold. The combination is debt, dollar, gold. That's the influencing items that all come down to confidence. And confidence lost is a currency event. And hyperinflation, that which I expect, is not an event economic. It's an event of a currency losing confidence in a very short period of time.
And you think we're headed for some sort of hyperinflation. A lot of folks, John Williams thinks that. Eric Sprott was talking about just recently a collapse or hyperinflation. You think the dollar gets hammered?
I think the dollar gets hammered. I believe that we are headed for hyperinflation, but it's important for the audience to understand that in every period where hyperinflation has been part and parcel of an economy, business was terrible. Everyone thinks that inflation has something to do with demand. They don't recognize that you can get a cost push effect, costs higher, because currencies go into disarray or lower. It's a currency event or loss of confidence in the dollar, which is going to result in a hyperinflation that gold will, without any doubt in my mind whatsoever, gold will insure the investor against.
And, you know, some people have written me, and just recently I had somebody write me, and I tell them, they say, oh, they're worried about the price. If I buy it now, could it go down? Did I already miss the train? Did I already do this or that? And, you know, I got to tell you that I'm not a trader. You are, and you have been, and you know people who do it well, Dan Norsini. I'm not a trader, but I just tell people that, you know, it's really kind of an insurance policy. How do you tell somebody that that is a gold holder that right now is a good time to hold gold because of the the situation that we're in, or if you bought gold, don't sell gold. If you bought it at a higher price, at 18 or 19 or 1,700 bucks.
Very simply, how do we know that tomorrow isn't the day or the day after? We have so many things, Greg, wrong in the economy, so many holes in the dike, so many fingers stuck in the dike to try and keep it functioning, that any one of those would create, what, 10, 20, 30 events that could create significant loss of confidence? Nothing has changed. Things have gotten worse. Derivatives haven't gone away. They've grown. Debt hasn't gone away. It has gone up exponentially. There is no argument that says that the dollar is entering into a period of strength. The U.S. economy's recovery is, at best, a straight line with a slight uptrend, but very slight, very fragile, very easily derailed, all of which affects confidence in the dollar. And gold is traded in the dollar. Loss of confidence by any matter can create a significant appreciation in gold. One, I believe, that when it comes about, will be brought about by the BRICS, and the price of gold, when it rises to the levels that I expect it to go to, will not fall more than 20% from those levels.
After it goes out, it's not going to crash again. It's going to go down and equalize.
And I firmly believe that this takedown is very similar to the two periods in the 70s where gold dropped sharply and where the gold banks and interests that would be considered to be anti-gold made the most on the long side in the shortest period of time.
In the 70s, I mean, when you said in 74 it's going to go to 800, people are like, ah, it's already gone from 35 to, 160 bucks. Get out of here, Mr. Sinclair. And it went down from 200 to just a little more than 100 bucks, 9 months later, in 1975. And, of course, it was 3 years later before it broke back to 200. I'm seeing a similar pattern with what's been going on the last few years, that we had this 1900. Now we had it got as low as, 1,200 or something, and now we're, crawling this wall back up. Is that the pattern you're talking about?
Patterns, Greg, are people. So what you're saying is you're seeing the same action of people. And the answer is it is exactly the same. There's literally no question about it. The people who make the most money over the shortest period of time in the gold market are always the gold banks, normally identified with the desire to depreciate the price of gold.
And last question in this segment, and then I want to get into a larger picture here. People will say, hey, I can buy GLD, or I can buy, exchange-traded fund as opposed to hauling around this old physical gold. What say you, physical or paper?
Physical, because the exchange-traded funds don't necessarily own physical gold. In fact, they own gold in various derivative forms. And their lending of gold is controlled by the same entities that are associated with the depreciation of price. If an exchange was to not necessarily even go into default, let's say the COMEX goes to cash settlement because the COMEX inventory warehouse of gold, that which is capable, able, and ready for delivery, goes down to too low a number, then you can expect the paper will come into question. And the question of paper is the question of the entire makeup. I'd say please read the prospectus before you feel the easy way, that is, of course, GLD, is the right way. It isn't. It's the wrong way.
Best way to have gold in hand, physical, in your possession.
That gold will ultimately function well just that way.
Okay. I was thinking the other night, and I've been actually last night, and I've been a reporter for a long time, since the 70s. I've never seen it this way. And one of the things that comes to my mind is that people, I think, are intentionally, willfully ignorant or willfully delusional, or they are in denial that we are facing and that we are facing something terrible. And my question to you is, where are we right now? What are we facing that people are just refused to look at?
We're facing the annihilation of currency. We're facing the shift of America as the leading and most influential nation in the world to some form of a banana republic. We're facing, if we lost our strength in military, into being a second-rate country. In the banking industry, we're facing the possibility of a bail-in rather than a bail-out. On the individual level, if it wasn't for food stamps, we'd have long lines waiting for free food. If it wasn't for the fact that we educate every night when we watch the evening news or when we watch the financial TV, that education says to us that everything is okay, that a bad figure was unexpected, and that the spin that's put on even negative figures is a spin that would give you confidence that there should be some recovery in the future. The figures that we're looking at are figures that have been so massaged since 1970 that I would suggest it would be hard for inflationary indices to show inflation, that it would be very difficult for the normal indices we look at that tell us the condition of the economy to be seen, as Mr. Williams lets us see through his eyes, in the true condition they are. We are in a decelerating recovery, which by definition, economically, is an accelerating recession.
You are boldly going around the world and telling people to get out of the system. Get out of the system. And surely one of the things you're warning people about is what you just mentioned, bail-ins. And I know the IMF, widely reported, that the European Union, I should say, I think the IMF laid this out, but they've been a plan laid out to start in Europe, and I can't imagine this wouldn't go around the globe, that they would take a percentage of people's net worth, including equity in their homes. Tell me about this, and why are you telling people to get out of it? First, why are you telling the people to get out of the system and bring in the bail-in question?
Because legally, the money that they've deposited in banks, and this is the proper legal definition going back to 1850 in British law, but also in U.S. and Canadian law, it says very simply that if you put your money in a bank, you're an unsecured lender to that bank. Unsecured lender. That's not even as good as a bondholder. So the lenders are going to take the brunt, not the taxpayers, is how this will be packaged and sold. The problem is the lenders are the people watching this program. The lender is the person who holds what he thinks or she thinks is money in the bank. That is their asset. The moment you put the money in the bank, it is no longer your asset. It becomes an asset of the bank, and you become an unsecured lender. Now, the IMF proposed one more and very important criteria for the bail-in, the recent bail-in, and that was that retirement funds are to be nationalized. After that, we've had retirement funds nationalized in Russia, where the Russians say they will pay back someday, and we've had retirement income nationalized in Poland, where there has been no comment on any type of payback. The IMF seems to be the center for all change that's taking place. Ms. Lagarde seems to be the voice of change in the banking system, which will put the onus of rescuing banks on the depositors and the bondholders, that the onus now is on the people watching this to come up with the losses, which if you'll take everything into consideration, in Cyprus, was a total of 83% of the assets, because when you get back worthless bank shares in a worthless bank corporation, you can't count that as money. And when you have a blocked deposit, which you've got to keep in the bank, you can't take out X percentage, you can't call that money. All you can call money is the check that is actually paid out to you. The loss was catastrophic. And the period of time when this was all being put into place in Cyprus, how did a farmer pay for the feed for his animals? How did a storekeeper pay his suppliers? How did the manufacturer pay his employees? How did a husband give a wife money to shop when all you could get was 200 euros? So the example of Cyprus, which we might have considered to be a small little Russian island pretending to be European, is in fact the blueprint for what we're going to experience here in the United States. Why bail-in is written right into the budget of the Canadians. It's written right into law in the Netherlands. It's written into law that most people haven't looked at. It's in white papers signed by the United States and the Bank of England, by the FDIC in the United States and the Bank of England. It's sitting there in BIS papers. People only have to look and see that they're in harm's way. Now, if you're in harm's way, how do you get out of it? You step to the left or to the right. So GOTS, or get out of the system, says if you sit there with your deposit in the bank, with all of your money with your broker, who are banks now in many cases, and these banks and institutions which took aid from the government, most likely the ones to blow up again, in fact do blow up, that your account, Greg, at your broker, your bank account at your bank are going to be hit for the amount of funds, and that it may even be extended to equity or profitable positions.
And for anybody who doesn't think this can happen to America, but people who think, oh, that's over in Europe or Cyprus or Poland or Russia, that would never happen to America. I mean, according to the FDIC, we have excess of $10 trillion on deposit. And there's no way that the FDIC can insure that. They got something like $33 billion in the deposit insurance fund, the DIF.
The insurance.
You're saying they're not going, the government's not going to ride in and make everybody whole. They're not going to print that money. If they did, if they did print that much money, it'd be disaster, wouldn't it?
The government is not going to make everybody whole. We're going to make the banks whole for their violations of good common sense, speculation, bonuses, high salaries, and the new rich of the world. And it's not the taxpayer, it's everybody, even if you didn't pay taxes and just had a deposit in the bank. And it's coming, it isn't coming isolated in the United States.
To quantitative easing, I'm watching the Business Channel yesterday, and they have Steve Leisman on talking about now if they're going to taper in the middle of 2000. That's the consensus. They're going to taper in 2014. And back to another one of your calls, back when they first started QE1. And I didn't even know you then. It was, after the meltdown of 2008. And back when they first started QE1, you came out and boldly said, oh, when they start this, they're going to QE to infinity. This is never going to stop. This is not going to stop. And sure enough, when I first heard that, and I'm sure everybody thought what I thought, that, oh, come on, they're not going to just keep printing money, are they? Come on. Well,
the answer is yes, Greg.
QE1 turned into QE2, QE2 turned into Twist. Twist is where we are now, where they keep saying, we're going to taper it. No, we're not. Yes, we are. No, we're not. And what is your view of QE? And, of course, this is going to dovetail into my next question about gold. They're not going to stop. They're going to QE to infinity. But what's your definition of infinity? It can't go on to infinity, obviously.
Now, what is the limit to QE? QE is limited by the condition of the U.S. dollar. What is the U.S. dollar tied to? Confidence. What is confident? What would happen if there was a loss of confidence? A higher price for gold. Clearly, we're not going to bring down the debt level. The economy is not in a bold, sustainable recovery. Europe is not in a bold, sustainable recovery. We are in a situation which is as bad or worse than 2008. And we've got so many figures and so many dikes that it would only be a miracle if it held together. A recognition of anything that affects confidence takes every finger out of the dike and brings in a situation as a multiple of the problems we went through in 2008.
Move on to my next question here, and that is what you said about the price of gold. And we're talking about a big spectrum call here. We're not talking about trading and trading an account, because as you said, trading gold is like trading your insurance. You don't want to trade your insurance, correct?
And you're up against the smartest minds in the world, and it's an inside game, and unless you're on the inside, you can't play the game.
So the best way anybody could do is go buy it, get it, possess it, and hold it.
And no margin, no borrowing on anything gold shares, GLD for that matter, no margin whatsoever.
You said something that I thought was profound on you said a lot of things that are profound on jsmindset.com, and that is that gold is going to go up. This is not speculation. This is policy.
It is definitely.
You take a look at China importing hundreds of tons of gold this year alone. They're the biggest, or if not one of the biggest gold miners in the world. They sell none of it. So they're keeping all their gold production every year. They're importing 800, 900 tons, 1,000 tons a year. Tell me about your long-term call that gold is going up because it is policy. It is not speculation.
long-term call on gold is based on the emancipation of physical metal from paper gold. And the tool of emancipation is the warehouses of the futures exchanges. For if the warehouses of the future exchanges can't be counted on to make normal deliveries, then the exchanges will have to make a change in the contract in order to avoid default, and they'll make that change to avoid default.
And question for you, let me interrupt right here. Is the day coming where COMEX or LBMA cannot or will not deliver gold, as what you're talking about? Is that coming soon?
Absolutely, yes. It's also the reason why I've just accepted a position as chairman of the advisory committee for the establishment of the Singapore Gold Exchange.
Oh, wow.
And this gold exchange is going to trade physical gold, not future gold. And we're basically trading a spot contract only, because the emancipation of physical gold from paper gold will allow a true valuation to be made. You can't come in. The way manipulation is done, and Greg, I've done it. It doesn't make me any better because I manipulated it up than the person who manipulated it down in another incarnation when I was 35 years old. But all you do is you come in and let's say you wanted it up. You bid for a year's production. Nobody's got it. Nobody's going to sell it to you. They run like mad to buy it from each other. Up it goes. So today they take it down by offering 2 or 3 years production in periods of time when there's very little liquidity. That's where you get these straight line downs from. But you can only do that with paper. You can't do it with the physical. So, because you have to make delivery. The Singapore Exchange, under my chairmanship of the advisory committee, will give cash 3 days and gold immediate.
So in other words, nobody can come out and say, yeah, I've got 5 million ounces of gold to sell. We'd like to sell it today on the exchange. And Singapore Exchange is going to say, great, bring it out here. Let's see it. You got 5 million ounces? Yeah. Fantastic. Put it right here on the floor because we're going to deliver it today.
Or put up the money it represents and deliver in 3 days.
Yeah.
Okay.
So there's going to be no more naked short selling, no more of putting your thumb on the price, and likewise with it going on the upside.
Likewise on the upside.
You want to buy it? Great. Where's your money? Yeah, we'll deliver it to you.
This type of exchange is taking place in Russia. They're starting a cash exchange on the Russian stock exchange. And there are 5 different locations around the world. Of course, I happen to think Singapore will be the leading one, but I'm a bit prejudiced there. Now, the emancipation, that is the event of emancipation of physical gold, the price finding mechanism from paper to physical. Now, physical gold will be much easier to hold price. Physical gold will be much harder to feign supply. Physical gold will be a product of gold taking its proper position as a value. In other words, everything against a value. That's what a standard was. That's what a standard is. So now the countries like China, and if you took a pencil, say you took a green pencil, and you took the entire world, and you filled in all the places in the world which are now valuing their gold at the market price, not at this assumed 42.22 the United States believes, you'll find out that half of the globe now is valuing their gold at market price, including the euro. So gold will be worn like a necklace around the neck of currencies that run their business correctly, who have the surpluses required to buy gold. And the value of currencies will be very strongly influenced, but not by automaticity, but influenced by the amount of gold held. That's why China is buying so much. That's why Russia is buying so much. Now, in 2016, where I see the first attempt of the Great Reset after the Great Leveling, I suggest that the BRICS will make this suggestion, and it will be ignored by the United States. By 2020, the Great Reset will be in place and probably claimed to have been the invention of the West. That's when we start as we were back in the 50s again, going into great long-term industrial agricultural expansions.
So that's so
value 32 to 3,500 before the Great Reset. After the Great Reset, I've got to leave that up to other people.
When is the Great Reset? What is that going to look like, the Great Reset? Is this the bail-ins? Is this the taking the pension funds, 401ks? Is this the dollar dropping? This is the Great Leveling?
That's the Great Leveling. In other words, we've had the Great Flushing. That was Lehman Brothers. The Great Flushing was Lehman Brothers. The Great Leveling starts next year and will involve everything you just mentioned.
Well, explain to me what the Great Leveling is.
Well, we can't have a middle class sharing the income with all the rich people. So you've gotten rid of the blue-collar class. It doesn't exist anymore. Go out to Detroit and try and find it. So functionally, let's say functionally, it doesn't exist anymore. So now it's time to take out the relatively comfortable white-collar guys that are making a decent living working for the corporations. Involving that would be a peak in the stock market. Involved in that would be higher interest rates forced by the market. Forced by a loss of confidence in the U.S. dollar, more so than a supply of treasuries for sale. Part of that would be the bail-in, because all of what the first two mentioned will uncover the bank's weakness in the black hole I told you about that's not accounted for, because the gatekeepers of accounting have declared it to be an accounting function that can be used. So after the Great Leveling, which should be 2014 through 2016, the BRICS, which have been accumulating gold and who have fundamentally better economies through the miracle of being able to bring people into a consumption function that up to now are peasants that had nothing. We're not consumers in any sense. This is the great miracle, where you bring in millions upon millions and billions of new consumers. That the fundamental strength of that equation is much greater than the real truth of the supposed economic recovery we've had in the West, where the BRICS go to a system where gold reflects the value of a currency, and the U.S. says, to hell with you, we're the U.S. dollar, we're not going to listen to you, no matter where the dollar is. In other words, with hubris. And then over the next 4 years, fall in line with the BRICS.
When you talk about this great leveling, and people are going to be wiped out. I mean, the stock market is not going to hold up. The day they announce they're going to start tapering, as they did in June of this year, isn't the stock market going to fall out of bed? Isn't that where all this wealth is, that Americans think they're going to walk out of the casino with all their money?
Liquidity has always been the grease of the wheels of equity markets, and the reason for why we have hyper liquidity. We don't have hyperinflation yet, but we certainly have hyperliquidity. You'd have to say all those trillions certainly don't sit in the modest category. So the stock market will find a value, as all stock markets have in the experience. There was a time when quite recently, when the finest index in the world was the Zimbabwe stock index. And so similarly, the real reason for equities being so strong is the subjective knowledge of what hyper liquidity means to general equities, but they all find a top, and when they do, the drop is spectacular. And the stock market is certainly, by all normal measures, quite a bit overextended.
What's your biggest fear? Why are you going around to tell people to get out of the system? What's your biggest fear, if you can sum it up in a couple of sentences?
Comfort in the banking system is misplaced comfort.
You think people could lose all their cash, or a lot?
I think that people could lose at least what was lost in Cyprus, 83%, one way or another.
And this is my last question to you, because everybody's waiting for a big call on gold. I pumped you up at the beginning. And your near term for gold, what's gold going to be doing in the next 2, 3, 4 months, 5 months?
Trying to better 1650, which is the pendulum point for gold. It will better 1650 and will rise to 2,400, drop, and then rise to 32 to 3,500 before we go into the Great Reset.
And that's before 2016. So you think gold 3,500 before 2016?
Yes, sir.
Will people madly be running into it? Will the bankers finally take their thumb off it and start pushing it up?
I think gold has a life of its own, and I think it has participants of its own. And my calculations for the price of gold are made without a world turning towards gold as a primary investment, but rather with those that normally are associated with gold losing their fear of the marketplace. that's been engendered by a manipulation that's taken gold from 1900 to slightly lower than the present levels, which seems to have bottomed.
What's your big call on gold? What's the big James Sinclair call on gold?
I'm almost embarrassed to say.
Let's hear it.
Gold emancipated. And here's a criteria. Physical gold emancipated from paper gold, which I believe will happen. Gold be worth $50,000 an ounce.
You got to say that again.
Gold emancipated, physical gold emancipated from paper gold. The formation of these new exchanges in which I'm involved. The result will be physical gold at $50,000 an ounce.
And for anyone who thinks that you're crazy, you made similar calls in 1970 after it went from 35 to around 160. Back in 2002, I think it was $360, and you said it would go up to $1,650. Surely did that and beyond that in the years following, and has come down some. So now $50,000. Are they going to confiscate gold, or are they going to confiscate some gold? In other words, I find it hard to believe that they would confiscate gold eagles after selling them to everybody.
Up to 2016 and 2020, when the Great Reset actually involves the West, the prediction on gold is 32 to 3,500. When gold is emancipated, it's 50,000. The reason for the confiscation of gold back in the 1930s was gold was QE. You had to have more gold to manufacture more currency. Now that doesn't exist. So if you're concerned that that gold will be confiscated, then what you're saying is you're going to be punished for being correct in the marketplace. I don't believe gold will be confiscated. Windfall gains tax, when gold is emancipated and goes to outrageous prices, yeah, windfall gains tax of some degree, but not 90%.
All righty. Jim Sinclair, you are Mr. Gold, jsmindset.com. I go there every day, incidentally, almost every day. Thank you so much for joining us for an extensive interview. And just to let people know, I mean, calling you Mr. Gold is really kind of almost an insult. I mean, when you trade gold, from my vantage point, when I look at people who do it and trade, you got to know everything. You got to know currencies, geopolitical. You got to know, stocks, bonds, QE. You got to know government. You got to know everything to trade gold. And so basically, I'm saying you basically study everything to come up with these kind of predictions. And I really appreciate you made an appearance here on USA Watchdog. Many people are going to be very happy that you came on. Jim Sinclair of jsmindset.com. Thank you very much for joining us today on usawatchdog.com.
You're most welcome, Greg. Thank you.